As we conclude the recent 13F season, the super investors have recently disclosed their holdings in the 13F form. Want to know what the top 5 picks in their portfolios are? Notably, the top-owned shares heading into 2023 remain dominated by big tech companies, a trend that carried over from the previous quarter when mega-cap tech shares were highly sought after. The allure of tech stocks stems from their potential for a rebound, lower valuations, and cost-cutting initiatives. So, in this video, we'll delve into the 5 most purchased stocks by our pool of 77 super investors during the first quarter of 2023, tracked by Dartaroma. Number 5 on our list is Disney, which garnered the interest of 8 super investors during the quarter. Disney's stock experienced a dip to a 52-week low of $84 per share towards the end of Q4, likely the main reason for its presence in this list. Notably, the highlight for Disney in Q4 was the announcement of former CEO Bob Iger's return to the top position for another 2 years, replacing Bob Chapek. The news of Bob Iger's comeback brought relief to Disney shareholders, as the company aimed to navigate the challenges posed by the macroeconomic environment and consumers cutting back on discretionary spending. To address this, Bob Iger intends to implement cost-cutting measures, including a reduction of over 7,000 jobs, while also considering the reinstatement of Disney's dividend in 2023 to restore investor confidence. As part of his restructuring plan, Bob Iger might explore the sale of certain businesses, potentially including ESPN. Despite the stock's decline in Q4, the return of Bob Iger and Disney's resilience in overcoming pandemic-related obstacles drew the attention of super investors. Additionally, Simply Wall Street's discounted cash flow model indicates that Disney may be undervalued. Nonetheless, prudent research is recommended before making any investment decisions. Moving on to number 4, Microsoft attracted the interest of 11 out of our 79 super investors last quarter. Once again, this can be attributed to the broader market sell-off affecting technology stocks, which presented our long-term focused super investors with an opportunity. When super investors perceive Microsoft to be trading below its intrinsic value, they seize the chance to purchase shares. Their approach is characterized by a long-term outlook, as they recognize Microsoft as a solid business worth holding for an extended period. Beyond the fluctuations in share price, Q4 held significant news for Microsoft, the release of OpenAI's ChatGPT on November 30th. Since their billion-dollar investment in OpenAI back in 2019, Microsoft has held a substantial stake in the company, and they recently announced an additional $10 billion investment. This strategic partnership with OpenAI aims to advance the development and deployment of artificial intelligence technologies. Through this collaboration, Microsoft gains access to some of the world's most advanced AI research and development capabilities offered by OpenAI. Leveraging OpenAI's expertise, Microsoft can enhance its own products and services, as well as create new AI-powered offerings that bring benefits to its customers. Undoubtedly, the attention garnered by the release of ChatGPT underscores its immense potential. Microsoft finds itself in a strong strategic position to collaborate with OpenAI in successfully bringing this groundbreaking technology to the market and capitalizing on its monetization. The integration of ChatGPT into Bing has already yielded increased popularity for the search engine. Moreover, plans are underway to introduce ChatGPT Plus, a subscription service anticipated to cost around $20 per month. This is the current buzz surrounding Microsoft. Yet beyond its AI ventures, Microsoft remains an exceptional business with numerous revenue streams derived from its software-based offerings. It is worth noting that Simply Wall Street does not consider Microsoft to be on fire at present. Nonetheless, in my opinion, it is an exceptional enterprise that warrants further exploration and consideration. Next, on number 3, we are currently associated with a rather controversial name, Meta, which garnered attention when it was acquired by 13 influential investors leading up to 2023. Among them, Seth Klemens stands out as he significantly increased his holdings by 150%. But before we dig deep about Meta, make sure you subscribe to this channel and hit the bell icon to never miss any of our latest updates on finance. Now let's delve into the situation surrounding Meta. It experienced a considerable decline in Q4, with its shares hitting a 52-week low of $88. It goes without saying that our savvy investors who heavily bought into Meta in November are now reaping the benefits, with the stock currently sitting at $170 just a few months later. However, despite these positive developments, Meta still faces numerous challenges. Mark Zuckerberg remains committed to the ambitious Metaverse VR/AR project, which may not be pleasing to investors at the moment. In fact, Meta's losses from Reality Labs amounted to $3.7 billion in Q3 of the previous year, escalating to $4.3 billion in Q4. Additionally, their annual capital expenditures have risen significantly, with total capex projected to reach $32 billion in 2022, compared to $19.2 billion the year before. Considering the substantial investments being made, the lack of tangible results is a cause for concern. Furthermore, Meta is being impacted by the macroeconomic environment. Advertisers are scaling back their marketing budgets, leading to a reduction in Meta's revenue. In 2022, their revenue only grew by 4% on a constant currency basis compared to 2021. Although they observed an 18% year-over-year increase in ad impressions, the cost per ad declined by 16%. This can be attributed to two main factors: fewer advertisers spending less money, and the shift in content consumption toward short-term video, which poses challenges for Meta's monetization efforts. Despite these short-term obstacles, our forward-thinking super investors, who made substantial purchases in Q4, have not been deterred. It's not surprising, especially when we consider Simply Wall Street's fair value estimate of approximately $200. This suggests that the investors saw great potential in acquiring shares at $88 in Q4, indicating a significant discount. While it's unwise to base investment decisions solely on website estimates, the disparity between price and value appears noteworthy. Overall, the current state of Meta entails various immediate challenges. However, the confidence displayed by our long-term focused super investors, coupled with the significant price-value discrepancy, implies a belief in Meta's future prospects. The second most popular stock among our super investors during Q4 was Amazon. Towards the end of last year, Amazon experienced a significant drop in its stock price, reaching levels not seen since 2020. So, what caused this decline? Well, it's important to understand that Amazon's success heavily relies on the spending habits of the average consumer. When the lockdown began and stimulus checks were distributed, Amazon flourished. Their revenue experienced a substantial increase during that period. However, when disposable income decreases, inflation rises, and costs go up, Amazon's performance tends to suffer. In recent years, Amazon has made substantial investments to expand and meet the demand levels seen in 2020 to 2021. Their capital expenditures increased from $16.9 billion in 2019 to over $60 billion in the past year. However, this surge in spending coincided with a decrease in consumer spending, which presented some challenges for the retail side of their business. Nevertheless, their AWS, Amazon Web Services segment, has served as a growth engine, reporting a 23% growth, while their North American and international retail segments experienced lower operating income in 2022. Therefore, despite the current environment, there are still positive aspects for Amazon. Additionally, Simply Wall Street indicates that the stock is relatively undervalued at present, which suggests that it might be worth investigating further. Now, let's move on to the number one stock purchased by our super investors heading into 2023, which is Google's Alphabet. Similar to Amazon, Google's stock declined throughout Q4, and interestingly, it hasn't fully recovered even now at the beginning of March. Google, despite having diverse business ventures, primarily generates its profits from advertising. Currently, like Facebook, Google is facing the challenge of advertisers reducing their advertising budgets. In Q4, we witnessed a rare occurrence as advertising revenue actually decreased compared to the previous year, falling short of the expected 20% to 30% growth. However, the same period saw an increase in headcount, with Google's workforce growing from 156,000 in 2021 to 190,000 by the end of 2022. The prevailing macroeconomic conditions have resulted in a decline in consumer spending, leading to reduced revenue for corporate America, including Google. Businesses are scaling back on their marketing efforts, which directly impacts Google's advertising revenue. Despite the decline in revenue, Expenses are rising as companies pursue expansion. Many organizations are increasing their headcount while also implementing layoffs. However, Google remains financially stable thanks to its strong position. The company holds $113 billion in cash and short-term securities, albeit $26 billion less than the previous year. In comparison, its long-term debt stands at $13 billion, making its total liabilities amount to $109 billion. Google's financial strength is evident, acting as a robust fortress. According to Simply Wall Street's discounted cash flow analysis, the stock may be potentially undervalued. The substantial investment made by Li Lu during Q4 further suggests potential value. Given these circumstances, it would be wise to pay closer attention to this situation in the coming weeks. These insights provide a glimpse into the top 5 super investor buyers during Q4 2022. Which of these stocks resonated with you the most? Are you considering adding any of them to your portfolio? Let us know in the comments below. If you enjoyed this video and want to stay updated with our latest investment insights, make sure to subscribe to our channel and hit the notification bell.